Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we'll continue with our conversation on the topic of successful stock market investing. So I've got a question for you. Do you think that you can consistently get it right in terms of when to allocate money to the market as it's about to lift off? Do you think you can get your timing right consistently to leave the market before we go through a bear or a downturn in the market? Now, it's very seductive to believe that that can be done. In fact, when we watch the news, you get the sense that most of the talking heads on the media have an ability to look at their crystal ball and tell us which way the markets are going to go. But I'm going to share with you some very important information that will set the record straight in terms of the whole discussion on market timing. Is it possible? Now, if you're new to this channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement, both the lead up to retirement, transitioning to retirement, and being retired. So if you don't want to miss the content on this topic or other retirement income planning topics, make sure you hit the subscribe button. Okay, let's take a look at this chart. This is a wonderful chart, a wonderful way of illustrating whether market timing or trying to time the market is a strategy that makes sense from a probability standpoint. Now, again, I want to preface my comments by saying the reason we're going through this discussion is that, first of all, there are many investors out there who are participating in the stock market, whether it's through individual stock ownership, exchange-traded funds, or mutual funds, who, if they could, they wouldn't really want to be there in stocks. So that they're temperamentally or psychologically not super comfortable, but they've arrived at the conclusion that they need the potential growth that stocks will provide to achieve their retirement goals and their financial goals. So they're kind of in this uncomfortable zone. Now, as a result of that, they're always, paying attention to, the talking heads out there in the media who purport to know what the future is going to hold, that they know when the bear market's going to hit, they know when the bull market's going to hit, and yet the reality is they don't. No one has a crystal ball to precisely tell you what the markets are going to do. Now, if you follow the talking heads, then you're going to increase the probability of underperforming. So you want to make sure that you remind yourself as you look at this data that this is what you need to latch on. So if, first of all, you need stock ownership in your portfolio to reach your goals, then the second thing is you need to play the high probability game. So what we're looking at is how market timing can actually punish investors. We're looking at the S&P TSX, the Canadian broad market between 2008 and 2017, and we're looking at staying invested versus missing the best days in the market. Now, this is a very volatile period in the market, but if we look at the 10-year period going to the end of December 31st, 2017, the compounded returns were 4.7% per year. And if you had to pick a pretty negative 10-year period, that was it. Now, that's the return you got if you just stayed in the market. In other words, you invested at that point for the 10-year period, and then you just rode the markets, you reinvested your dividends. Now, if you missed the top 10 days over that, let's say 2,500 plus trading days over that time period, your return ended up being minus 1.5% compounded. And if you missed the top 20 days over that time period, you compounded or lost at a rate of minus 5.3%. And if you missed the best 30 days over that 10-year time period, you compounded your losses at minus 8.2% per year over that time period. Now, when you look at these numbers, this really confirms what the problem is. Over a 10-year period, let's say roughly 2,500 trading days, if you were trying to time the market, what's the probability that you're going to get that right consistently and not get it wrong consistently? And I would argue that if you're trying to time the market, and it's a very few number of days that drive most of the returns, the probabilities are really stacked against you. So if 10 days in the market basically drove most of the returns in the portfolio. So dilemma number one when it comes to market timing is there are very few days over an extended time period that actually drive most of the performance in the stock market. So it's very concentrated. It's not like it's a consistent upward trajectory. No, it's very inconsistent, and there's some days that are much more significant on the upside than other days. So that's the first problem. The second problem is once you leave the market, so let's say you're trying to time the market, you think there's a lot of excessive volatility, you want to leave the market, protect your capital with the idea that you're going to go back in, right? Because for this strategy, market timing strategy to work, it presumes that you will at some point go back into the market to capture the returns that you want. So when you exit the market, psychologically, that is a hard thing to do, right? Because contrary to all the things I'm talking about, many investors know there's a little voice in the background saying, I'm not sure if this is a productive strategy. But anyway, you do it. So now you have money in cash. And now you're waiting for an opportunity to go back into the market. So my question for you is, how much positive confirming information are you going to need to take that cash now and move it back into the market? And what we tend to find with investors is they need a lot of good confirming information. But what happens again is that when markets move on the upside, much of that upside happens at the point of maximum pessimism. It's at the point at which you would not normally expect it. If I go back to March and April of 2020, because of the downturn in the market, the COVID virus and the closing of economies sort of triggered, no one would have been able to crystal ball what was going to go on over those 2 months. It was very, very extraordinary. But take that over the sweep of a 10-year period, it's the same kind of idea. It's very difficult to have a crystal ball that's going to tell you what's going to happen. And so you're waiting for more and more confirming information. By the time you decide to reemploy your capital back to the market, guess what? You've missed likely most of the market growth for that cycle. And that's one of the reasons why it's not a productive strategy. If you're going to be an equity investor, so this is the one takeaway, right? Then you're an equity investor. You can't hop back and forth. If you hop back and forth, you are going to sabotage your success. Now, it doesn't mean that you don't fine-tune your portfolio, scoop off the profits, rebalance your broad mix to maintain the integrity of the mix. I mean, there's basic maintenance of a portfolio that always is going on, but major tactical swings around either being in the market or out of the market are just not productive strategies. Okay, this is a great chart because it tracks the impact of emotions in investing. And so what we're looking at here is the Canadian stock market, the broad index, the US stock market, and international equities, broadly speaking. And then we have another set of lines that take a look at the market if you'd sat out 1 year in the market. And we'll talk about what year that was. And we'll compare the difference in ending portfolio values. So if you look at the chart, we're at 2007, and the portfolio basically goes out to the end of 2020. And what you see, if you went through the financial collapse in 2008, but stayed fully invested. So you thought, you know what, I'm not smart enough to play this market timing game. I'm very unsettled. This has been very unnerving, but I'm going to stay fully invested. Well, your portfolio in the U.S. market would have grown to $354,915 over that time period. And if you look at the Canadian market, it grew to about $206,377 as an example. So the way it's summarized here is if you look at the chart down here, these investors stayed out of the market for 1 year. So the market collapsed, they pulled the money out, and they decided not to go back in until things seemed to be improving, right? So if you stayed fully invested, again, Canadian market over that time period was $204,546, US market $354, almost $355, international equities $163. If you left the market for 1 year, your Canadian stock portfolio wasn't $204, it was $125, difference is $79,000. US market was $354, almost $355. If you sat out a year, your value was $206,000 roughly. You were out of pocket $148,000 in growth. And then if you look at international equities, you're looking at $163,000, $92,000 if you sat out a year, so a difference of $71,000. So the bottom line is there was a very significant cost to investors that decided to go to the sidelines and then eventually went back in once they thought the news was positive enough for them to do that. So the wisdom here in these slides is that it's not a productive strategy to try to time the market. Again, if you're going to be a stock investor, you need to be a stock investor. You also need to have enough time on your side with a stock portfolio that when you go through the short-term volatility, you don't have to pull the money out right away. You can allow the money to recover so you can get the full value from the portfolio over time. Well, it's my hope that you found this presentation helpful. Again, if you are looking for additional resources in the retirement income planning and wealth planning area, don't hesitate to visit the various links that are contained with this video. You can get to our website. If you go to our website, make sure you send us an email if you're interested in talking about our retirement coaching service, or even have suggestions for future videos that we can provide to you. We're always looking for new video topics, and we'd welcome your feedback. As well, if you're not subscribing yet, make sure you hit the subscribe button so you don't miss any of the future content on this topic, but other topics around retirement planning and wealth planning. You take care. Wishing you all the best in your retirement planning journey and investment wealth planning journey as well.